Well, as the sparkling stars show you, it is pretty exciting that we made it to the last chapter. It always, there's an age-old saying, it always feels impossible until it's done. Now, we're not quite done yet. We've got one chapter and then, of course, a 12-chapter, 2-day final. But the end is very much in sight, and we will finish with ample amount of time for our seniors to leave. So exciting, exciting, and more excitement. As I just got done explaining, we'll get through 12.1 here today. So here is what you need to know. I mentioned the fixer-upper duo, who the gentleman, Chip, is battling a lawsuit right now because of a bad partnership that basically had the celebrity ties to it, and HGTV was going to hire him, and he knew it and dissolved the partnership, bought him out, and 2 days later, all of a sudden, HGTV news surfaced. And so you could say that's a little sly on his part, but at the end of the day, it's just people being cruel, and anyone is suable, and that's what's going on there. Again, I'm not sure where it stands right now, but I just thought the timing of some partnership gone bad news in the mail, or in the news, was well timed. So what is a partnership? At its most simple definition, a partnership is an association of 2 or more people to carry on as co-owners of a business for profit. What you need to know is it's 2 or more. You can have many partners. It's just that it's not one person, it's 2 or more people carrying on as co-owners of a business for profit. What types of businesses typically are based around a partnership? Small retail stores, perhaps service-based businesses, manufacturing companies. You can even see accountants, lawyers, doctors formed as partnerships. And if you think about a lot of law firms have like 8 names as part of the law firm. Do you know what I mean? Okay, you see the same thing with the accounting firms, doctors, dentists can form partnerships to create those businesses, and we'll talk more about that. A few characteristics of a partnership. You still probably aren't using my notes yet. You're emphasizing your own notes. What you need to know is it brings together groups of individuals. The partnership becomes its own legal entity, so the partnership can get sued. It becomes its own accounting entity, so in other words, the owners or co-owners in this case have their personal books, but then they also have their business books, and together it's a separate accounting entity. And net income not taxed as a separate entity, just one more feature of what a partnership is. A mutual agency can be defined as an act of any partner is binding on all other partners, so long as the act appears to be appropriate for the partnership. So basically, a mutual agency is whatever your partners are doing has your name attached to it as well. So if there's a bad egg in the group, your name is attached to that as well. If there's a bad egg, you're all bad eggs. Okay. I want to read to you a little bit more about mutual agencies from the book because that is pretty broad. And I'm just going to read to you the paragraph. A mutual agency means that each partner acts on behalf of the partnership when engaged in partnership business. The act of any partner is binding on all other partners. This is true when partners act beyond the scope of their authority as long as the act appears to be appropriate for the partnership. Let's get to an example here. For an example, a partner of a grocery store who purchases a delivery truck creates a binding contract in the name of the partnership, even if the partnership agreement denies this authority. On the other hand, if a partner in a law firm purchases a snowmobile for the partnership, such an act would not be binding on the partnership. The purchase is clearly out of the scope of the partnership business. What does a law firm need a snowmobile for? Okay, but you could agree that a grocery store needs a delivery truck. So again, if you've got some bad eggs making bad decisions, a mutual agency is basically, if it's in the scope of what the business is intended to do, all the partners better buy into it or buy into the notion of it. A few more characteristics of partnerships. Limited life. Dissolution occurs whenever a partner withdraws or a new partner is admitted. So basically, as partners are added and subtracted from the mix, it doesn't mean the business ends. It simply means that partner has the limited life. We'll get into what if a partner dies, what if a partner leaves, but just know that partners within a partnership have a limited life. They can come and go. What is unlimited versus limited liability? We're going to get into the examples here in a minute with the notes that I provided, but basically each partner is personally and individually liable for all partner liabilities. Yes. I don't think so. No, corporations would be publicly traded companies where all the stockholders would own the partnership. I mean, I don't think you want 45 partners, but yet if you think about it, there could be 45 doctors in a hospital, and they'd all be partners. And yeah, so I don't think so. It's a corporation when you decide to become a corporation and your shareholders own slices of the business. Unlimited means simply this. If the business can't pay the debts, they're going to attack you personally. So if Junk by Jenny, which is, I'm a bad example because I'm not a partnership, but if I can't pay my bills from my business, I better be ready to pay my bills out of my own pockets. That's what an unlimited liability means. Limited means you're put in a bubble. Okay, you're only going to be in the business bubble. They can't go attack you from a personal standpoint. We're going to get into that here in just a minute. Co-ownership of property. Basically, each partner has a claim on the total assets. Okay, if there's two people and there's one delivery truck, they technically own half of that delivery truck, each. If you've got a warehouse, they own the warehouse and they share it. If there's inventory in the warehouse, they share it. So each partner has a claim on the total assets. This claim does not attach to specific assets, though. It's just you take a look at what do we own, and we all have a claim in that ownership. All net income or net loss is shared equally by the partners unless you decide otherwise. You know, if Ira and I go into business together, and Ira's like, you know, I only want to be 30% into this business. You're 70%. Well, guess who gets 70% of the net income? Guess who gets 30% of the net income if we're not a half and half split? But in rough times, if it's a net loss, I get 70% of the hit. He only experiences 30% of the net loss. Does that make sense? Okay, so a lot of partners are a 50-50 split. Some of them are 30-70, 40-60. You can, and then as you add partners, you of course add percentages in. Okay. Organizations with partnership. Basically, there's special types of partnerships out there, and we're going to talk about them. Limited, which they're in a bubble. We'll talk more about the bubble in a minute. Limited liabilities, or LLPs, and limited liability companies, or LLCs. And instead of just listing them, what I did was make a big chart for you to say the different types of partnerships, otherwise known as these acronyms, and pros and cons of each of them. So why don't you find my notes? Yes. Or LP. All right, so here we go. Find that handout that I gave you. General partners are otherwise known as a regular partnership. So general partners or a regular partnership is simply that, a regular partnership. That's the AKA. Here is what you need to know. Some advantages: they're very simple and inexpensive to create. From a disadvantage standpoint, the owners are not in a bubble. They are personally liable for all business debts. So if I go into, if I'm a general partner with someone 50-50, if we can't pay our bills from the business, where are we going to pay our bills from? Our own pockets. Again, I'm going to read to you a little bit more about the different kinds of partnerships right from the book. If you're starting a business with a friend and each of you have a little bit of capital and your business isn't very risky, you probably want to go with a general partnership. They're easy to establish and they cost hardly anything. Okay, so let's say you and a buddy want to start a lawn mowing business. Okay, you'd be general partners. If you can't pay your bills, you better be able to dig in your pocketbooks. Okay, it's simply that. That is really all it is. You could just go into business with someone. Okay, let's go into the more complicated ones. Limited partnerships, otherwise known as LTDs or LPs. I do want to tell you what those stand for. You probably can tell what LP stands for, limited partnership or limited partner, or LTD stands for limited. What you need to know about all of these, another AKA, is that they are in a bubble. It's not like they're a silent partner, but they're untouchable in their own pocketbooks, in their own pockets. Okay, if I'm a limited partner and the business can't pay their debts, they're not going to be able to attack my personal money. Limited partners have limited personal reliability. It's a pro. Limited partners are in this bubble. They can't grab their own money for business debts as long as they don't participate in management. Take a look at that. So if you're a limited partner, you can't be part of the management team. So it almost sounds like you're a silent partner, doesn't it? General partners can raise cash without involving outside investors in management of business. So there's general, within a limited partnership, there might be a general partner who isn't in a bubble and can be personally liable and professionally liable, whereas the limited partner is got bubble wrap around his or her own personal money. From a disadvantage standpoint, general partners, you wouldn't want to be that one. Well, that happens all the time, but the general partners are personally liable for business debts. So do you see the difference there? It can be seen as an advantage for the limited partner because they personally are not liable. But if you're the general partner, you are personally liable for any debts that can't be paid after the business pays. Then they're going to attack you from a personal standpoint. They're a little bit more expensive to create than a regular partnership because it's more complex, it's more contractual, and they're really great for, you can't see this under here, but real estate. Again, I want to read to you what the book says about limited partnerships. In a limited partnership, one or more partners have unlimited liability, not in a bubble. Okay, we can attack. They can be attacked personally, and one or more of the partners has limited liability. So you hear them referred to as I'm the general partner or I'm the limited partner. We still could go into business 50-50. It's just that one's a general and one's a limited. The words limited partnership or LTD or LP identify the type of organization. For the privilege of a limited liability, the limited partner usually accepts less compensation. So they might not get paid as much, and we know that they can't be a manager. If the limited partners get involved with management, they risk their liability protection. In other words, the bubble could break. So why would you want to be a limited partner? You can't be a manager and you might get paid less. Why would you? What's the huge advantage of being a limited partner? You're in this bubble, and what does it protect? Personal, your personal money. What's the advantage of being a general partner? Higher risk but potential higher reward. Yes. Let's keep going. Go ahead. It's a good question. Let's keep reading. In many real estate partnerships, the general partner puts 1% of the money in and the limited partner puts 99% in. The general partner gets an added fee for managing the property. The general partner gets another fee when a property is sold. Property is often held at least 10 to 15 years, which the limited partner gets cash distributions of. So there's why it's a disadvantage. They're very much a silent partner here. Good question, though. On to the next one. We're getting into some of the specialized ones. Now we're talking LLPs. Limited liability partnerships, otherwise known as LLPs. Riverview is an LLP. That's part of their actual business name, Riverview LLP, right? So they're a limited liability partnership. Can you already tell the word limited means the partners are in a bubble? Okay. Some advantages. Mostly of interest in partners in old line professions. So you see law firms, doctors, accounting firms in those old line type professions. You know, most law firms have been around for 100+ years because the forefathers started them and then the next line of the generation started them. Okay. Owners or the partners are not personally liable for the malpractice of other people, because you are all in bubbles. It's the first L of the L, limited liability. You are all running around not personally liable for paying off debts, and you're not personally liable for the malpractice of other partners. Most states allow professionals such as lawyers, doctors, and accountants to form LLPs. It's designed to protect innocent partners from the malpractice claims resulting in the act of another partner. LLPs generally carry large insurance policies as a protection of the malpractice suits. Some disadvantages. I keep fighting with my recording. Partners remain personally liable for many types of obligations owed to business creditors, lenders, and landlords, often limited to a short list of professions. Not everybody gets to be an LLP. helpful hint that I see in the book. In an LLP, all partners have limited liability. There are no general partners. So maybe add that in here. There are no general partners in an LLP. It does say this: partners remain personally liable for many obligations, but the biggest thing is if there's malpractice going on, that partner will be sued, not all of the partners. Does that make sense? So if I'm in an accounting firm and I'm doing unethical things and we're an LLP, my partners are not going to be personally liable for the malpractice that I'm doing. If you'll notice though, we still are all personally liable for different obligations, debts, different stuff. It's just that if there's a bad egg, it's bubble wrapping all the partners so they aren't coined as bad eggs. Finally, the last one, LLCs, limited liability companies, otherwise known as LLCs. Again, they have limited personal liability, even if they are management. So do you see the big difference here? Remember on LTDs or the limited partnerships, the limited partner could not participate as management. If in this one they can. Limited personal liability, even if they are a manager. Very expensive to create. Why? Because there's different rules here. Contractually, there's more to deal with. Again, I'm going to read to you what the book says. A hybrid form of a business organization, which certain features like a corporation or other limited partnerships, is a LLC. An LLC usually has a limited life. The owners are called members and have limited liability, like owners of a corporation. Limited partners do not actively, whereas limited partners don't actively participate in management, in LLC you can. So if there was a question on a test, how is a limited partner different than a LLC partner? LLC partners are still limited, and in their bubble, they can't be personally sued, but yet in LLCs, they can be part of the management team. Holy cow, that's a lot. On page 570 is that list that you just created, like that exact thing is on there, okay? Just remember the four, well, first of all, general partnerships, and then we've got limited partnerships. There's a general partner, there's a limited partner, and the limited partner's in a bubble and can't be in part of the management team. There's LLPs and there's LLCs. The LLPs are kind of those age-old firms like a law firm or an accounting firm where, yeah, they might be personally liable stuff, but the limited part, the bubble part, is protecting from bad eggs. The bad doctor, the bad lawyer, the bad accountant. The rest of them are fine, they're safe. Versus LLCs are basically more of a corporation that the limited partner can be part of the management team, okay? The last thing that I want to talk about, and it's on your handout, what happens when two or more people decide, well, we want to start a partnership? It's a legal thing, so you typically would have to follow a certain set of steps, and here they are. To make this official, the names and the capital contributions of the partners need to be listed. So again, I'll use Ira and I as an example. If we're going to start a lawn mowing business, Ira and I, we'd be quite a team, wouldn't we, Ira. And if we're going to be 50-50 general partners, we say that. And maybe I'm going to provide the lawnmower, and Ira's going to provide the weed whipper and a little trailer that we drive around with. Okay, so that would be our capital contributions. Plus, we're each going to put in $1,000. So I'm going to provide some stuff and some money. Ira's going to provide some stuff and some money. Then also, to make this officially a partnership, we have to decide what rights do we have as the partners and what are the duties of the partners. Maybe Ira's going to take care of all of the bookkeeping. He'll be the behind the scenes. I will be out getting contracts and getting people that we can mow lawns for. What's going to be our basis for sharing net income? Are we going to be a 50-50 split? Are we going to be a 70-30 split? Oftentimes that relates to our initial capital contributions. We both put in $1,000. We both put in about the same amount of stuff. Well, if I would have put in $10,000, would it have been a 50-50 split? No. We're going to get into that Thursday, Friday on how we actually journalize the creation and distribution of net income and the dissolution of the partnership, but that'll come later in the week. We're going to make a list of what if we want to withdraw assets. So what if we want to withdraw cash? What if I want to take my lawnmower back, or the different, other assets? So when we want to withdraw, how does that look? How are we going to solve disputes if we can't solve our disputes collectively? We go into what's called arbitration, where they bring in like a middleman to help us solve our problems. What if one of us wants to withdraw, or what if we want to add Morgan to our business? Then what happens? And what happens if one of the partners dies? So that's the basic checklist as you form a partnership. Yes. That's a good question. I still think they're still individual people. Anytime it's partnerships with family, it gets messy. If anything, the name will change a little bit if one of the partners changes the name. Obviously, the female in that case. It gets a little bit tricky here and here. Hopefully, the married couple can figure out the disputes. It's still two people. It's still partners. They just happen to be married. It's a good question. Legally, you'd have to probably talk to the lawyer and work out how that changes things. We are only going to do 4 questions. There are not any brief exercises that go with this section. This is much more vocabulary based. So we're going to do questions 1 through 4. I would like you to try them on your own first. We've got time. Take 5 or 10 minutes to answer the questions. You can add them just onto a notebook piece of paper because, of course, there isn't any workbook pages that go with this. You'll find them on page 593 in your book. And again, I just want you doing questions 1 through 4. You certainly can look in your book. You can look in your notes. And then we'll answer, or I'll show you the answers here in just a few minutes. together. We'll go through the first 4 questions that you did. See how the chapter likes them answered. On page 593, they're listed, and number 1 actually has 3 parts. The characteristics of a partnership include the following: association of individuals, limited life, and the co-ownership of property. Explain each of these. The first one, part A, association of individuals. A partnership is a voluntary association of 2 or more people, and it really can be based on a handshake, which seems crazy. I would highly suggest involving a lawyer. Preferably, the agreement should be in writing, or in other words, create a contract. A partnership is both a legal entity and an accounting entity, but it is not a taxable entity. Okay. I'm going to read a little bit more about the tax side of it. The net income of a partnership is not taxed as a separate entity, but a partnership must file an information tax return showing partner net income. Each partner's share is taxable for their personal tax rates, okay, regardless of the amount of net income each withdraws from the business during the year. So in other words, it's just like they go to work at their business and they would prepare taxes personally, not based on the business. Those should be B and C. That's my mistake. Limited life. A partner does not have an unlimited life. A partnership, excuse me. A partnership may end voluntarily or involuntarily. Thus, the partnership is indefinite. Any change of members can result in the dissolution of the partnership. So members will come and go. The partnership can live on as long as there's members. Co-ownership of property. Partner assets are co-owned by the partners. If the partnership is terminated, the assets do not legally revert to the original contributor. So going back to the example of Ira and I, if I contributed a lawnmower, at the end, I don't necessarily get the lawnmower back. We divide up the assets. It's not like as soon as I contribute a lawnmower to our lawn mowing business, the lawnmower becomes the partnership. It's no longer mine. Number 2, it's talking about a mutual agency and unlimited liability. Kevin Mathis is confused about the partnership characteristics of a mutual agency and an unlimited liability. Explain these 2 characteristics for Kevin. A mutual agency. This characteristic means that the act of any partner is binding on all the other partners when engaged in partnership business. This is even true when partners act beyond the scope of their authority, as long as it appears to be appropriate for the partnership. Just remember the law firm snowmobile example that I read to you from the book. If a partner goes out and buys a snowmobile for the law firm, that's not acting with the best interest of the partnership. If a grocery store partner goes and buys a delivery truck, they are contributing to the mutual agency. Okay. Unlimited partner is, what you need to know is they are not in a bubble. It's unlimited. Each partner is both personally and individually liable. If we can't pay our business debts and we're unlimited partner, general partners, not in bubbles, if we can't pay our bills, they will attack our individual bills. We're personally and individually liable. Okay. Creditors' claims first attached to the partnership assets. So they're not going to like attack you at home in the night or anything, but if people can't pay, if the partnership can't pay the bills, they're first going to attack all the partnership assets, and then they would go to the personal resources of the partner beyond that. Number 3. Lance Koniski and Matt Morrison are considering a business venture. They ask you to explain the advantages and disadvantages of the partnership form of organization. There's definitely advantages. Combining skills and resources. Like I mentioned with Ira and I, maybe he's all the behind the scenes guy, he's doing all the books. I'm the sales task going to get new clients. Again, you capitalize on the skills of the 2 or more people. They're pretty easy to form. They're fairly free from government regulations and restrictions, and it makes decision making a little bit easier because you're pooling together, again, those combined skill sets. As far as disadvantages, that mutual agency thing is considered a disadvantage. You know, if one partner is out buying silly stuff for the partnership, you got to work that out. Okay, it does have a limited life, and it is an unlimited liability where both personally and individually people can be attacked, so to speak. Finally, number 4, why might a company choose a limited partnership? In other words, there's a bubble around 1 or more of the partners. A limited partnership is when a general partner wishes to raise cash without involving outside investors. Limited partners have limited personal liability for the business debts as long as they're not in management. Where can they be in management? What kind of structure can a limited partner be a manager? LLC. LLCs are very expensive to form because there's just a lot more paperwork, a lot more legalities. If you're confused on any of this still, reread the book. That's what I did. Not that I was confused, but I just wanted you to have that clarification reading right from the book. Google or YouTube search some different forms of partnerships. Class won't be officially going tomorrow because so many of the seniors are gone, but over the course of Thursday, Friday, we'll get into some journal transactions. How do we form a partnership? How do we share net income? And how do we dissolve a partnership?